Day 33 of the series. Let's continue with the problem set of the fourth chapter, mutual funds and other investment companies. So the 18th question is, you purchased 1,000 shares of the new fund at a price of $20 per share at the beginning of the year. You paid a front-end load of 4%. Securities in which the fund invests increase in value by 12% during the year. The fund's expense ratio is 1.2%. What is your rate of return on the fund if you sell your shares at the end of the year? So initial investment is $20,000. After 4% load, net investment equals to 20,000 times 0.96, which is $19,200. Gross return, gross ending value before fees, which is 12% increase in the value of securities. So 19,200 times 1.12, which is $21,504. Expense ratio, 1.2% reduces return. Effective return equals to 12% minus 1.2%, 10.8%. So final value equals to 19,200 times 1.108, which is equal to $21,273.6. Return is equal to 6.368%. Pretty cool stuff. It's question number 18. Question number 19 is, a loaded up fund charges a 12B1 fee of 1% and maintains an expense ratio of 0.75%. Economy fund charges front end load of 2% but has no 12B1 fee and an expense ratio of 0.25%. Assume the rate of return on both funds portfolios before any fees is 6% per year. How much will an investment in each fund grow to after 1 year, 3 years, and 10 years? So loaded up fund versus economy fund. Portfolio gross return 6% annually for both. So the loaded up fund, there's no front end load. There's a 12B1 fee 1% and expense ratio 0.75, which is 1.75% of total annual fee. Net annual return 6% minus 1.75% is 4.25%. The economy fund charges front end load 2% and has expense ratio 0.25%. So 2.25% minus 6% from the 6%, which is equal to 5. Front end load is separate. Sorry. Expense ratio is 0.25%. So net annual return will be 5.75%. Front end load is 2%. So So 0.98. Okay. Future value formula, FV equals to initial times 1 minus load times 1 plus net return to the power T. Makes sense. Power T. Okay. So for the first year, loaded up fund is 104.25% of initial investment. Economy is 103.365. 3 years, something. Okay. Economy fund outperforms after 3 years despite front load due to lower annual fees. So that is the answer for the 19th question. Okay. For the 20th question, City Street Fund has a portfolio of $450 million and liability of $10 million. If 44 million shares are outstanding, what is its net asset value? Net asset value will be assets minus liability divided by shares outstanding, which is 440 million divided by 44 million, which is $10 per share. And then we have, so that's part A. Part B is if a large investor redeems 1 million shares, what happens to the portfolio value? Shares outstanding and NAV. So if the large investor redeems 1 million shares, okay, $10 per share, so that's 10 million out of the fund. 10 million gone from the fund. So portfolio value would be portfolio value would be portfolio value would be 440 million, I think. And what else? Part second, shares outstanding. Don't they stay the same? I don't know. I have to check this one. Oh, shares outstanding go down 1 million. Interesting. $43 million shares, and then we have the NAV, which would be equal to the new portfolio value. So that'll be like, I don't know, like, yeah, that'll be like 430. Yeah, it'll still be $10 per share. That's nice. So yep, no change in the NAV, no change in net asset value. What else? 21, the investment fund sells Class A shares with a front-end load of 6%, Class B shares with 12 B1 fees of 0.5% annually, as well as back-end load fees that start at 5% and fall by 1% for each full year the investor holds the portfolio. Let's read that again. Investment fund sells Class A shares with front-end load of 6%, Class B shares with 12 B1 fees of 0.5% annually, as well as back-end load fees that start at 5%, fall by 1% for each full year. The investor holds the portfolio until the 5th year. Assuming the portfolio rate of return net of operating expenses is 10% annually, if you plan to sell the fund after 4 years, are Class A or Class B shares better choice for you? What if you plan to sell after 15 years? Okay, so let's read that again. Class A shares, front-end load 6%, okay, 0.94. Initial investment factor, should 21 fees of 0.5% annually, as well as back-end load fees that start at 5% for 1% each year. Hmm. So Class A 6% front load, note will be one for final value equals to $1 times 9.94 time is 1.10 to the power 4, which is equal to 1.376. Class B, no front end load, 0.5% 12B1 annually, back end load year 4 equals to 2%. Back end load year 4 equals to 2%, yeah, true. Then I will return 10% minus 0.5%, 9.5%. Third value after load will be 2% back end load. Yeah, okay. So yeah, final value before load, before back end load would be 1 times 1.095 to the power 4. Because we're subtracting 0.5 from 1.10 to the power 4 because 4 years is the time span. So that's 1.43766, and then after 2% back end load, that would be times 0.98, so 1.4089. So class B is better at 4 years. 15 years, class A is slightly better. Class A is better at 15 years. Answer better choice 4 years class B, 15 years class A. Okay. 20. Second question. Mutual funds. Yeah. You are considering an investment in a mutual fund with a 4% load and an expense ratio of 0.5%. You can invest instead in a bank CD. CD was what? Commercial. No, CD was. What the hell was a CD? I'm forgetting. Credit deposit? No. Commercial deposit? Commercial deposit, I think. Commercial deposit. Certificate of deposit. Yeah, okay. Certificate of deposit. There it is. Okay. Alright. So, mutual fund investment, 4% load, expense ratio 0.5%. You can invest instead in a bank CD paying 6% interest. If you plan to invest for 2 years, what annual rate of return must the fund portfolio earn for you to be better off in the fund than in the CD? Assume annual compounding of returns. If you plan to invest for 2 years, what annual rate of return must the fund portfolio earn for you to be better off the fund than the CD? Okay, CD is paying 6% interest, or 6 percent. So 1.06 squared. This is 1 point, so that's like 12.36% return. What else? 2 years, okay. Front end load and an expense ratio of 0.5%. Interesting stuff. So let me maybe write this down somewhere. Maybe I can write this down here. So needs to be 12.36. Say higher should be x. So write it down from this thing from the CD. Okay, sure. So final value equals to 0.96 times x minus 0.5%. So minus 0.5 plus 1. To the power 2. This should be this should be I actually don't know. It's interesting. Good question. Damn. So 2 years of CD final value equals to 1.06 squared 1.1236. Yeah, that's what I did. Fund with 4% loan expense ratio fees as we will return 0.96 times 1 plus r minus 0.005. Go ahead and do that. Sort of. I mean, I can correct the formatting a little bit. So let's say let's keep it x only. I want to change to r. We can change to r. Yeah, sure, it's r now. Anyways, 1 plus r minus 0.00005 squared. So that would be equal to CD. Okay, sure. So yeah, so 0.96 times r plus 0.995 whole square equals to 1.1236. So we solve for r, we get 8.686% required gross annual return as the requirement for us to invest in the mutual fund instead of the CD. So there's that. And then part B is how does your answer change if you plan to invest for 6 years? Why does your answer change? So if it's 6 years, then it would be 1.4185 and then 7.22%. Why does your answer change? Doesn't say that. Part C. Now suppose that instead of a front-end load, the fund assesses a 12b1 fee of 0.75% per year. What annual rate of return must the fund portfolio earn for you to be better off in the fund than in the CD? Instead of front-end load. Acha, sure. Okay. So that return minus 0.0075 expense ratio 0.5 plus 0.75%. Okay. Let's read expense ratio. What? You know what? Let's just skip this question. Who cares? Yeah, sure. Not skipping the question, we're skipping the part. So skipping the C part because apparently DeepSeek is also confused. So we can't do anything about it. Anyways, question number 23. Suppose that every time a fund manager trades stock, transaction costs such as commissions and bid-ask spreads amount 0.4% of the value of the trade. If the portfolio turnover rate is 50%, by how much is the total return of the portfolio reduced by trading costs? Let's read that again. Suppose that every time a fund manager trades stock, transaction costs such as commissions, bid-ask spreads amount to 4% of the value of the trade. If the portfolio turnover is 50%, how much is total return of the portfolio reduced by trading costs? Okay. 0.4% value trade. Okay. Yeah, okay. Turnover rate is 50%. That means 50% of the portfolio value traded during year. Cost per trade, 0.4% of trade value. So 0.4%. Round trip trade sell then buy cost 0.8%. Turnover is measured as minimum sales purchases 50% effectively someone replace trading cost 0.4% times 50%. 0.2% of total portfolio per year one way cost. Alternatively, some assume turnover implies buy plus sell, so cost 0.4%. So common convention return reduction 0.2% reduction in total return because of the trading costs. So yeah, that's pretty much it. A little bit confusion there because it says some people assume turnover implies buy plus sell. Some people assume it's one way. So it's it depends. So we haven't been told what to assume. So we will just assume the first thing, which is 0.2% reduction in total return, which is fine, should be fine. Question number 24, you expect a tax-free municipal bond portfolio to provide a rate of return of 4%. Management fees of the fund are 0.6%. What fraction of the portfolio income is given up to fees if the management fees for an equity fund are also 0.6%, but you expect a portfolio return of 12%? What fraction of portfolio income is given up to fees? Why might management fees be a bigger factor in your investment decision for bond funds than for stock funds? Can your conclusion help explain why unmanaged unit investment trusts tend to focus on the fixed income market? You expect a tax-free municipal bond portfolio to provide a rate of 4%, management fees 0.6%. What fraction of portfolio income is given up to fees if the management fees for equity fund are also 0.6%, but expect portfolio around 12%? What fraction of the portfolio income is given up to fees? Why might a management fees be a bigger factor in your investment decision for bond funds than for stock funds? Can your conclusion help explain why unmanaged unit investment trusts tend to focus on the fixed income market? So 24 question. Municipal bond fund. Uh, Municipal bond fund portfolio return 4%, management fee 0.6%, fraction given up to fees 0.6 by 4, 15%. Equity fund portfolio return 12%, management fee 0.6%, fraction 0.6 by 12 or 5%. Management fees are a bigger factor for bond funds because expected returns are lower. So fees consume a larger share of income, portion of income. This helps explain why unmanaged unit investment trusts focus on fixed income. Lower management fees are more critical in low return environments. So that is the second last question, and the last question is question number 25. Should we be doing it right now? Suppose you observe the investment performance of 350 portfolio managers for 5 years and rank them by investment returns during each year. After 5 years, you find that 11 of the funds, so we are really right 11, but 11 of the funds have investment returns that place the fund in the top half of the sample uh, each, in each and every year of your sample. 11 of the funds are invested per top of the sample each and every year. Such consistency of performance indicates to you that these must be the funds whose managers are in fact skilled, and you invest your money in these funds. Is your conclusion warranted? Uh, no, the conclusion is not warranted. With 350 funds, the probability of a fund being in the top half each year by chance is 1 by 32. Expected number by chance 350 times 1 by 32 is 10.9, very close to 11 observed. Thus, the outcome is consistent with random luck and does not imply skill. So we should not invest our money in those funds just because they came in the top half each time. It can happen due to random luck. Okay. We are on the problem sets. Yeah. Sure. Okay, let's just go through the CFA problems now. We should probably... Oh, there are no CFA problems. How about that? Okay. So we're just gonna do some questions from the Indian perspective. Download the data on net asset value and price of any 5 closed-end funds from the website of AMFI. So let's go to the website. Okay, our website is amfindia.com. Alright, there it is. Interesting stuff. Good website. Is there any difference between net asset value and prices? Price. What is the average discount you find here? Closed-end funds. Fund. Investor. Knowledge center. Starboard fundamentals. Non mutual fund types. Access mutual fund and fund services easily. Probably this one. Wait there. Okay. I guess so. Yeah, sure. There it is. Introduction mutual fund, types of mutual schemes, spend ratio, yeah, no online center. Invest online. What's the center? Distributor. Research and information. Mutual history. Well, I just wanna... How do we... Risk metrics. Well, we just wanna load data on NAV and price of any. How do we do that? Closed end funds. Are there any closed end funds? Which one to choose? Cap fund. Motilal Oswal Flexi Cap. Is this closed end? Huh. Flexi Cap. Interesting. On details, downloads. Oh, there is. Access scheme information. Fact sheet. Motilal Oswal fact sheet. Oh, look at this. Whew. What are we supposed to do? A lot of fun. Sure. Pratik Agarwal. Looks like a thing. Anyways, holy hell. Okay. That is a lot of information. I don't know what I'm supposed to do here. Oh, there it is. Net asset value. There it is. Okay. So it's 33.18 rupees. And where do I find the price? You know what? How about I just skip this question? I'm really not understanding anything. Franco's Investor Center. How about this one? We already are here. Investor Center. Customize. Track your. Download various forms. Consult account statements. Gas. Okay, let me ask DeepSeek. Hello. How do I see data on NAV and price me 5 closed and funds from the website of EMFI? Is there any difference? NAV and the price. What is the average discount you find in there? Closed end schemes. Okay, let's pick 361 mutual fund. Sounds nice. Oh, you know what? Let's pick Access Mutual Fund. That seems like a good fund I've heard about. Let's pick a closed end. Closed end isn't there. I don't know what to do. Closed end schemes. Let's scheme type. What about this one? Regular plan. Multi-asset allocation fund, direct plan, growth. None of them say closed end scheme. Like NAV report in text format. All NAVs for a date. Historical NAV for a period. Now it's here for 2 dates. What the hell? Oh shit. Let's accept that. Okay, I'll end the video. I'll continue in the next one.